You're listening to the RE Social Podcast with your hosts, Andrew and Vince from OnV Invest. For more information, go to onvinvest.com.
What's up, guys? Welcome to another episode of RE Social Podcast. Today we have a cool guest, another guy from India, Sridhar. Welcome to the show.
Hey, good evening. Thanks for inviting me to the show.
Yeah, of course. We would like to make the white guy the minority today. So
what?
Yeah.
Hold on. The name one more time.
Sridhar Sannidhi.
Yeah. Try that again. Slow it down for me.
Sridhar Sannidhi.
Sridhar?
Sridhar.
Yeah, Sridhar. Yeah.
Sridhar?
Yeah.
Yep.
Got it. Very cool. I need to start working on like maybe some.
Come on, bro. You know
Hindi.
me.
We're
for
trying to
10
travel. I'm like trying to go to India, and I don't even know how to say cheers, and that's usually where it starts for me.
years.
I'll throw.
Okay.
Yeah, that's Russian.
Yeah.
Anyways, well, it's a pleasure to meet you. I'm Andrew, by the way. I am doing more of the operations. All the Airbnb kind of questions tend to be fielded my way. And the analytics, purchasing, selling, super nerdy stuff is obviously in the other side of the room. So tell us a little bit about your journey. Let's get some information for our audience about yourself. Give us maybe a minute or two of just kind of where you're coming from and where you are now, sir. How have you achieved all of your greatness?
Sure. My name is Sridhar Sannidhi, and I'm from India. So, as you all know, most of the Indians, they come here on work permit. I'm also like that. I came here on a work permit. I came to US in 95 on a work permit. Since then, I've been in the IT industry until this January. I worked in all the Fortune 500 companies, mostly worked in Wall Street for more than 20 years, I would say, and all the financial firms, and then big tech companies. And recently, I came out of Google. So now I'm full-time into commercial real estate. In this 30 plus years of IT journey, I played multiple roles. Started the career as a developer initially, and then database administrator, and then to cloud architect. That was my last journey in the IT space. While I was doing it, I was working on a few entrepreneurship ideas, and none of them worked out in the IT space. So that's when I thought that I need to do something else before I can go back into IT space to start another new venture. So one of the thoughts I got was to build a single family portfolio, and single family portfolio ended up as a dream because there was a lot of competition. I could not build any portfolio. So I ended up thinking big and changing my mindset to go for big and fast. So I entered commercial real estate space, and I attended multiple events. And one of the events, I came across this multifamily program. They're offered by a couple of mentors, and then I looked into it, and I felt very promising. So I started that multifamily journey from that point onwards. Initially, I did a passive investment. After a quarter, I started getting the check. Then I got excited and said, let me go for active investments. And then within 6 months, I partnered with somebody whom I met at that event, and then closed a 96 unit deal. Is a heavy value add. Since then, the journey started, and then I started acquiring more and more bigger units, anywhere from 96 units to like 416 units.
Nice.
Yep.
Yeah, sorry, we had a little camera issue, but we can hear you. Nice.
Yep.
Wow. So let's just get some nice stats out on the board then.
Yep.
How many units are you involved in right now?
So as a GP, I was part of 3,700 plus units. Currently, I manage 2,000. We sold 1,000 plus units last year. And as an LP, I have 11,500 plus units.
That's wild.
Yeah.
Very cool. And for the audience, just in case, can you give us the difference between the GP and LP stuff?
Yeah, LP is a limited partner, which is mostly a passive investment where I would invest in someone else's syndication, where they would manage on a day-to-day activities, and then they will send me the return either monthly or quarterly. So that's the LP part of it. GP means I will be the active sponsor of the deal. So I will do day-to-day activities from the asset management point of view. We acquired the property. We hired the professional to run the property for day-to-day operations. And we do asset management on those properties.
And it sounds to me like, you've got a lot of experience in both of those worlds.
Yep.
Tell me in the audience a little bit of, the pros and cons, where you're seeing yourself in 5 years in terms of the LP versus GP side of things.
Sure. LP thing is mostly passive. Is like you can also say mailbox money. You invest the money. Your risk exposure is the amount of money you invested in, and you will keep getting the returns, whatever the deal offers, like either quarterly or monthly, until the deal does the full cycle, means whatever the value add they project, right? The value addition completes, and they sell the property, and they give the capital gains as well as your principal back at the end of the cycle. So that is the LP part of it. So the investor doesn't need to do anything on a day-to-day basis.
That's the pros. Yeah. And the cons is you might lose the cash because you're not in control of the deal.
Yep. The cons is like you don't have control on the deal. So you need to trust the partners where you invest in. So you need to thoroughly do the due diligence and check the underwriting before you invest in.
What kind of hot tips? Sorry to interrupt. What kind of hot tips or hacks, or just say, what do you look for in criteria when you want to partner with somebody?
Sure. For partners, I look at their track record, how many deals they have done, what type of deals they have done, in what markets they have done those deals. And second thing is, what is the median household income in that area where the deal is present. And then I also look at employment growth rate, those kind of generic numbers from the market. Based on that, how the rent grows. Rental growth also I check. If those numbers look good, then I will go for that.
Got it. Yeah. So you're doing your own market research on the side and vetting the deal and the company itself. Nice. Yeah. And what kind of markets are you like mostly in and or excited about right now that are reflective of that criteria?
So I invest in mostly Sunbelt states. So where the investment is investor friendly rather than tenant friendly. So it is easier to evict non-paying tenants in the Sunbelt states versus the other states. And also I look for larger properties, typically 200 plus units I invest in, not smaller ones. And mostly working class neighborhoods.
Got it. And just to kind of circle back and revisit, what were some of the, pros and cons of the GP side? It seems to me like you're kind of moving yourself over to the LP side as of late. Is that correct?
So right now I'm balancing, but eventually I wanted to be more passive. But at the moment, I have a lot of active deals. I think around 15 active deals I have. So that being said, like for an active one, you need to find the property and you need to assemble the team. You need to raise the funds, go through all this due diligence process, and then acquire the property, hire the management, and then make sure that we're meeting the KPIs and deliver the returns. Even after doing all that, if we get caught into some super cycles or something like that, you need to make sure that you navigate those. So
Yeah,
those
you
challenges.
said super cycle.
Yeah, super cycle. Like right now, the interest rates are very high. Like usually, the interest rates are normal, right? This is a super cycle. Once in a while, you see very high interest rates in the commercial space, and then it comes back to normalcy. But if we have not provisioned cash properly, and then we will have cash starvation in the deal, and then we need to manage those deals and manage expectations from investors' point of view and protect their investment.
Love it. I feel like I'm kind of hogging the mic over here, Vince. What do you got?
Yeah, so I was just gonna go to some. I like to keep a timeline going. So you said you were in the IT business, right? The software. I'm a mechanical engineer as well. So how did you have the understanding to go from, especially you said you worked in Wall Street and Google, so I assume you're making good money. How did you figure out that's not going to really give you the retirement stuff or the passive income? And how did you turn on to real estate after your initial entrepreneurship didn't work?
So, as I mentioned earlier, right, I was very keen on starting IT entrepreneurships, but a couple of times my partners walked out of the good prospects, like the companies which we wanted to form, and later on they became multi-billion-dollar companies. So I felt very bad. The main reason I could not continue on that is I didn't have funds. So I thought that I need to build a net worth. By working in a corporate job, I cannot build a net worth. So I need to build some portfolio. The easiest one to build a portfolio for income or net worth is real estate. So initially, I thought that I may not be able to buy the bigger properties. I need to have all the money. That was my thought. But after learning all this multifamily business, it was very easy to do syndications and build the net worth while doing full-time job. So because you have partners who can take care of the properties while you are working and doing some of the roles as a GP, that way you can one can build their portfolio and then build the networks. So 5 years back, I started this journey. In 5 years, I did so many deals, despite the fact that we have COVID, despite the fact that the economy is fluctuating a lot.
Yeah, man. So you said that you first started out with single family. How far did you get along that path, and why did you stop doing that?
So single family, I started long time back, like 20 years back. I bought in India mostly. Those real estate single family lots, like apartments and all, I'm sorry, they appreciated a lot. But they were remote, so it was difficult to manage. So I thought it's not worth managing that way. So I thought I should have some professional team to manage it. Initial thought was to buy multiple single families and hire a manager to manage all that, or maybe some service to manage it. So when I went for this single family acquisition, there was a lot of competition. So net cash flow was very small. So I was scared to put the large amount of down payment to get the very small cash flow. So that kind of discouraged me. And I was thinking like, okay, there could be some other opportunity somewhere that I should look into. I should not give up simply because this particular single family approach didn't work. So that made me believe to explore hotels, motels, and all that. And I tried to do syndication in hotel, and they asked me to down pay like $1 million. I didn't have $1 million cash at that time, so I said, okay, let me pass on that hotel, motel endeavor, and then see something else that can be done. And then multifamily one, I learned that I can start a syndication with $100,000 or even less, and then go from there. The journey.
Nice, man. This is something that I wanted to ask. So, especially even for Drew and other people listening. So, you mentioned owning properties in India, and, my family has some stuff there too, but the loan products are very different in India, right? So, can you
Yep.
elaborate on how, what it is? And it's probably not a 30-year fixed amortized loan, right?
Yeah, in India also you have like variable interest rate loans mostly. So they give that, and then the term changes every year, right? Whenever the Fed there changes the rate. And most of the time, people would pay off the loan after a couple of years. Particularly people who invest from here, they end up making it as 100% cash investment. Even though initially they take the loan, but they will pay it off. But here it's mostly on the leverage. That's what helps us to build a bigger portfolio at a faster pace. Whereas in India, you cannot build that many properties quickly because the loan LTV is very low, interest rates are high typically, and managing them is also a challenge remotely.
And these are 5-year terms, 10-year terms, 15-year terms.
I took 5-year terms in India for a couple of the properties, but I paid them in 4th year so that I don't have to worry about the loan payments and all. Yeah, I
It's
was
still a
able to
huge
pay it.
difference though. From
You can't even
30-year
do it.
fixed to a 5-year AR, like an adjustable rate, which by the way, anyone listening knows that's how
Yeah.
2008 happened. Like, so has anything like that ever happened in India like we had in 2008?
There was slowness, but it would never crash there. But there
Mm.
was a slowness. Even now, also, there was slowness in parts of India, but population is growing. Land is a limited resource. It kept on going up. But only negativity is like rupee versus dollar, right? The rupee
Yeah.
becomes weak day by day. So even if your investment goes up because of that weak currency, you will lose in translation.
Got it.
Yeah, there's something this is, this part of the macroeconomics that I really like. So, it's very important what Sridhar is saying. So, a lot of people say, hey, why don't we buy in Belize and, Colombia and India, right? So, you could be like, oh, this guy is all racist. He only wants to buy in US. I'm from India, so I don't care what you think. So I'm giving you the answer, right? So my family owns some stuff in India and they bought it, let's say, about 20 years ago. And they bought some properties that has gone up in value. So everybody understands. However, like Sridhar just mentioned, like offhand, like, yeah, the rupee to dollar is changing. So it changed by 100%. So when we bought it, it was $1 buys 40 rupees, right? That's when we bought stuff in India, right? Now we're going to sell it. Right now it's 85 to 1.
Wow.
So if it went up by 100%, we made $0 if you
Wow.
bring the money back. That's
Right.
the game we're playing. If you're going outside of US,
What timeline was that?
yes, I would say maybe 15 years, right? Does that sound
Yeah.
right? Yeah,
Yeah.
15 years. 15 years, you just lost 100% of your money. If it went up by 100%, you made $0.
And that's the downside if you anticipate bringing that money into the US.
Yes, that is the downside of longer term. So if right now India is looking to be doing pretty good for the future, however, we are not the reserve currency, right? Which means tracking to the dollar, you're still going down every year. So if you hold it for 20 years,
currency,
you're gonna lose unless you
Wow.
play different kind of games. It's very
I have a
interesting.
story for you. So one
Yeah.
property, the first property which I sold in India,
Mhm.
it went up by I think close to 400%.
Nice.
I brought that is in the span of 20 years.
Mhm.
I brought that money and then it ended up like 30-40% gain net after paying all the taxes and everything and adjusting to the currency devaluation, right?
Yeah.
So that money I put it in the first deal. In 3 years, I doubled it. So in US,
so your first deal in the US, you're saying?
yeah.
Can you walk us through that? I was going to ask you that specifically here on my notes, is to ask you,
So
can you give me the first deal, like how it started, what you sold it for?
sorry, the second deal which I exited, second or third deal which I exited, I put in that one. No, not the very first deal. First deal still I won. Correction there. So the first exited deal, I would say.
Yeah, sure, that's fine.
Okay,
Walk us through
so the very first deal, I met this one of the partner in one of these real estate events. And we got excited and we said we should buy some property and start doing the syndications. And then it's a 96 unit. It's in Wichita Falls. And then the purchase price was $3 million. So we had to raise close to 1.2 or $1 million. I had no idea that I could raise money or anything like that. I was thinking that maybe I could put my own money, couple of $100,000 if need be. So the others would raise the money if that is the case, right? That was the thought I went in. So three of us, each of us put 100K as GPs. The remaining money.
10 GPs?
3 GPs.
3 GPs?
Yeah. So
you said it was $1 million.
1.2 million raise, 300K we put our own money, 900K we had to raise. So I reached out to a bunch of, I was thinking like, how do I raise the money? So one of the GPs said he has no network and he cannot raise. So that leaves us, me and another friend of mine. So I took the phone directory and I looked at profiles of some of my close friends, and I saw who are the ones who would really join me in this exercise. So I looked at the profile. Some of them, they do investments. So I immediately realized that they have risk tolerance. So I should put my case in front of them and say that, hey, I'm doing this one. I'm putting so much money. Are you interested? So I called around 20 people like that. Even though I have like a couple of hundred contacts in my phone book, only 20 people I reached out. To my surprise, all 20 said yes.
Whoa. Hold on. Your first deal, you have no experience with the exception of some stuff in India.
Yes.
Is that you just have great relationships, or was the deal just that obvious?
So first they saw that I'm putting 100K of my own, but I asked for 50K investment from them. So they said that this guy is putting more money, and they know me personally, how dedicated I am when it comes to work. So they kind of took it as calculated risk and said, let us come into this one and see. Worst case, we will lose this 50K, no liability, nothing for him. So anyway, he will not let it happen. And the real estate usually don't fall just like that, right? So that is another thing they were counting on. So they came into the deal, and out of that 900K, I believe I raised 600 plus K by myself.
Wow. It's a good friend network.
600 to 700K I raised, remaining 200K my friend raised.
Nice.
That's it.
And they're just your professional and family friends?
Yes.
Yeah.
That gave me motivation. Then I said, we need to go bigger and better. Bigger and bolder.
So these people like kind of reinvest with you, or how are you?
Yeah, my investors, 60 to 75% of them are reinvestors.
That's great.
Yeah.
And sorry, I'm just kind of curious. I like to kind of close out chapters in my brain. That's how I work. Yeah. For that first deal, do you still own it, or what's happened?
We still own it. The price, the valuation has gone up, but
what's it worth today?
If we exit, I think right now they may get like 100% return, but we are kind of expecting 200+% return. So we are going to hold up for a few more months until the market becomes favorable.
Sure. And by market becoming favorable, what metrics are you really looking for?
So the interest rates have to come down a bit. So right now, the interest rate, net effective interest rate is coming around 7-8%, right, in the open market. So that should come down to 5%. So I'm thinking that by 2025, it should come back to that level.
Nice. Yeah, I'm hoping so as well. We've got a nice portfolio. Just to speak quickly about us, we're 5 years in like yourself, but nowhere close to your amount of units. But yeah, we've done a lot of duplex, triplexes, and definitely use the advantage of leverage. You know, we had 20K in our safe,
each.
We were rich each. We were wealthy. And just send it all in on a prayer and a triplex. Long, short, not to make this about us. I want to make it right back to you. But yeah, it's interesting that 5-year trajectory of just like, you're learning all this stuff and putting that money in. And the capital raise thing has become definitely a lot easier now that we have the track record. But I'm just so impressed that you're able to do all of that, like 600K on your first deal. It's just really inspiring to hear how
Yep.
huge those are. And that's something I think Vince and I would love to get into eventually. In terms of, because I'm a manager, I wanted to kind of go down this road real quick. How are you managing it? How are you navigating all that stuff? You just have a company, call it a day. How do you vet them if you do?
You mean on the acquisition side or managing side?
On the, actually both.
Okay, on the acquisition side, I mean, the first few deals I was doing everything very heavily,
Mm-hmm.
right from finding the deal, underwriting it, and then making sure the numbers are working out like that. And then some of the deals my partner brought in, so like that. Even if he brings in, then I do my own underwriting and due diligence and all that. Once we have the deal under contract, then reach out to more and more investors. I mean, this we constantly build the network. Once we have some deals, right, it's easy to expand your network. So now I started reaching out to more wider audience and I started raising funds like that. Yeah, that is the acquisition fees. The management also initially, in every deal, I'm hands on. Wherever I'm an active partner, most of the people, I mean, not most, like some of the people, they do like a fundraise and then they get a little exposure into the deal afterwards. They get occasionally they join the meetings and see what's going on from the deal perspective. But it's in my case, I attend every single meeting with the property manager.
Nice. And are you meeting with them? How often are you meeting with the property manager?
Once a week.
Once a week. Nice. Is it in person? Is it a Zoom call?
It's a Zoom call. So I attend every single property manager, unless I'm in travel or something that comes up. So
great. You got your finger on the pulse.
Yep. So
what kind of tools, and I want to kind of reverse real quick for analyzing the deal, what kind of tools are you using? I just am very like value centric. How can I give our audience value in this conversation?
Sure.
What kind of tools?
So after first 4 or 5 deals doing like that, I started hiring virtual assistants. Now I built a business process and downloading the deals, underwriting the deals, and making sure all the initial due diligence is done on the deal. So I don't do all that manual data entry now. So I have 10 virtual assistants working for me at the moment. So they do different functions in this real estate. Couple of them, they do this downloading the underwritings. I mean, downloading the deals and does the underwriting and then does the due diligence. They use a Google Sheet mostly. It's simple so that we all can share the same data set. I have created my own underwriting sheet.
Nice.
I'm taking samples from a couple of other deals and then making sure that it is easy to enter the data at the same time. I will have full picture on the deal. So that's how I built. I looked at a couple of other tools, but they are very expensive at the moment for me. So maybe once we grow a little bigger, then we may revisit that. That's from the acquisition point of view. Once I see some deal is working, then I pursue that. I go under PSA and then I acquire and all that. So for fundraise point of view, I partner with multiple other GPs. Nowadays, I'm lead GP in every single deal I'm associated with. I build a team and then we raise the funds. If there is any shortage, then we do creative financing to fulfill the shortcomings. So that is the approach I'm doing. In last year, it was, 2023 is terribly bad when it comes to funding and all that. Its market is really, really tough to do any deal. Despite that, I did like 4 transactions in 2023, 3 land acquisitions and 1 multifamily acquisition.
Why is it more difficult now? I kind of have an idea of where you're going to go, but just for the audience, right now it's November 2023. Like you said, interest rates are around 7 to 8.
Yep.
What else is going on? What do you think is making it a struggle?
So the LTV, so they have they reduced the LTVs on the loans. Earlier, we used to get up to 80%, anywhere from 70 to 80%. In 2022, also most of the deals are 70 to 80% LTVs. Now, 50 to 60, 65% LTV. So, which means that for every single deal, we need to raise a lot of funds.
Less leverage.
Lot less leverage. And obviously, when there is less leverage, the returns will be less. The cash on cash will be less.
Right.
The equity portion will increase in the deal. The leverage portion will reduce. So as a result, the cash on cash won't be that lucrative what it used to be in previous years. Even the overall capital gains also. Now, the amount of equity in the deal is high, so you have to make a lot more profit to give them more returns. So very few deals will work in that fashion, and also the interest rates are high. So as a result, the expenses are high. Interest rate expense is high, right? So net income would be low. So all these challenges are popping up. So acquiring a new deal, definitely we need to be very, very cautious, and we have to be very thorough on our underwriting. That's why I started doing more construction deals now than existing multifamily. So
say that again. Transaction deals?
No, now I branched into construction deals.
Oh, construction deals. Okay.
So
you're building your own property. Is that what you're saying? You just bought, 3 of the last 4 deals were land, you said?
Yeah, land. Yeah.
Okay. Wow.
We bought the land. Now we are going through the entitlement process. Once the entitlements are done, then we'll start the construction.
That's awesome. And what kind of areas are we building new apartment buildings?
We have, currently we are building one in Princeton, 306 units.
Is that Florida?
No, Princeton, Texas.
Texas? Okay.
So another one, we got the land and we got the entitlements done. Now we are going through the loan process, and 330 units in Melissa. And another one I'm doing in Austin. So we acquired the land into 3 different transactions, right? 20 acres. So we are going to build a hotel, townhomes, retail space in that's one.
Awesome. Wow. That's a whole different learning curve, I'm sure.
So another one I'm doing is single family lots. So now I started looking into a couple of other construction deals, partnering with a couple of other owners or team members like the GPs. So another 300 plus units we are looking into. So changing the game plan a little bit, because the existing ones are not that promising unless we have a real good deal, unless we get a real stressful asset.
Love that. Yeah, that's smart. That's what any good entrepreneur would do, is shift based on market demand. And that's awesome. I was actually going to ask you about creative financing. Sounds to me like you've got way ahead of the curve on that. You're like, let's just build our own stuff. What are some of the challenges that you've faced in that shift of your business model, and now you're building the home? What are some of those learning curves? What are some of those things you wish you knew before? Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that OnV Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire in a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to onvinvest.com for more to see if you qualify. And thanks for listening.
Yeah, definitely. Vetting the general contractor, and then the contracts in general, like types of contracts that are available out there, which one is the best one, type of thing. I wish I had more knowledge when I started. I consulted few experts, but each deal is unique, right? So
what pro tips and can you give us in the audience on how to vet contractors?
Yeah, particularly the general contractors. For construction, there are different types of contracts. One is um, cost plus contract, means like the contractor will give you the invoice for each item they purchase or complete, and they take a percentage cut on that activity. So that way, um, as the owners, will get the best pricing, but we are susceptible for any price variations. That's one type of contract. Another one is like a guaranteed max price contract, in which, irrespective of the market fluctuations, the final price is fixed. So the contractor will take the fluctuations, and he will bear that, and we'll have the final pricing fixed. So that way we will have a better deterministic outcome from the property deal.
Got it. That's great. Yeah, we've entertained that conversation a couple times, but not come close to striking on it. We actually are buying a new build, from new builders right there in the Tennessee, great red state of Tennessee.
Yeah.
We've had a lot of squatter issues over the years, so we're a little bit more cautious in California and blue states in general. So, Vince, any comment on that?
Yeah, I wanted to chat a little bit about, a lot of our listeners, are younger in terms of in the investing game. So they're either trying to get in, or they have a few properties, or a lot of them are also passive. So if someone is deciding to buy their next deal, or, their first deal at this moment, which is, let's say, November, December, early 2024, you've been in the game for a long time. So, what do you see? Like, what kind of moves can they make, or should they just sit on the sidelines and keep waiting for interest rates to go down?
I'm not a believer in sitting on the sidelines. I go with the market. I see market is good all the time, provided you used your underwriting with the right parameters. That's my philosophy. So okay, so what I'm saying is, I am a strong believer in not sitting on the sidelines.
Yeah, because
I like do the deals, but with the right parameters. You underwrite
Yeah.
with the right parameters. What I mean is, like, you underwrite for the higher interest rates, higher cap rates, and then cushion for longer term. Like, if things are not working out well, like if you have high delinquencies for some reason, you need to have enough cash to run the property. Like that, if you underwrite like that, and if the deal still works, go for it. That's what I would say.
yeah, that's a good response. And if they are passively investing, do you well, I guess they got to know how to question the deal maker, right? Like the sponsor. So that's another thing. So it's just that it comes to it sounds like a lot of education. You really have to surround yourself.
Yeah, definitely. So in the current market, right, a lot of people are witnessing the capital calls, right, after buying the property. Now the deal is not able to cash flow enough to pay for the loan, and also as a result, the sponsors are asking for more money from the investors. So my suggestion to LP investors is, first, they need to see the underwriting to make sure that the assumptions are good. So the cap rate that they're buying in is at a higher rate. That's almost like equivalent or closer to the current interest rate. That's what I would say. Then they would be more successful, I would say. And the second thing is the assumptions wise, the rental growth and all, it should be more meaningful, like historical averages, like 10-year average. What would be the rental rate growth? That should be the assumption. I mean, good old days, people were underwriting with 5% rental increase. In the current market, we may not be able to see 5% rental increase. We may be, but we should see the underwriting at 1 or 2%. And another thing is whether the sponsorship team is allocating enough cash to see the smooth functioning of the property. And finally, the JP team, the sponsorship team, is financially very sound. If things are not going as planned. If they had to put the money in, they should be able to put the money in. They should not come to the individual investor. So that would be my biggest requirement in the current market. GPs should be very strong, and they should be able to fund the deals.
It's crazy because when for listeners who are listening, is when Sridhar's talking about, okay, well, it's a 5 cap and we're borrowing it at 8%. What means is if you took a loan for 50% LTV, you're losing 3% on that 50% you just borrowed, which means you're paying out of pocket to just hold on to the loan, which is insane. So that's what a lot of people are doing. So they're raising more capital and like trying to, pay distributions from the amount raised, hoping they could raise. I mean, did you see some of the stuff that's going to foreclosure? Robert Martinez just got foreclosed on a $51 million property in Texas.
Yeah, and prior to Robert, there were a few other foreclosures.
Yeah.
And if the market continues like this in 2024, we may see more foreclosures. Yeah. Right now, multifamily foreclosures are very less compared to office space.
Yes.
Office space is brutal. I think a lot of big players also lost money, and then they gave the keys to the lender and walked out.
Yeah. Wow. That's crazy. So,
as somebody who has a commercial business, I actually have a music school. Yep. This is my plug, everybody. But no, it's definitely, I don't own the building.
We should.
We've definitely entertained that, maybe with a second location. But point is, I actually have stood to benefit from that because I have a physical location and they have not raised the rent on me since the contract expired. It's a 3-year contract. And there's not even been a single conversation in terms of raising it per the square foot, which is, I think, fairly normal, normal circumstances. But with Amazon and online, the fact that I can get on Uber Eats and order, pretty much anything right now, it's definitely shifted a lot. Are you completely? So what's interesting is, I think you said you're building something that has some retail space. Is that correct?
Yes.
And so are you worried about that at all? Or is it just such a booming population growth, job growth that you're confident it'll be fine? Or
it will be fine in our project. There are a couple of reasons we are very confident. Is first, the property that we are building, it itself has townhomes. Of course, that is not sufficient for the complete retail space we are going to build. And the next door, there are 1,200 apartments coming up.
Got it.
So that itself is a big market. Yeah. So we see this retail space should be able to support that 1,200 unit apartment complex owners, and also there are a bunch of homes in the vicinity, and not that much retail space is there. So we are betting on all those factors.
Gotcha.
Yeah, man, that's crazy. Market's a little crazy. You got to know what you're doing. Lucky for you, you started, a long time ago, and you're really killing it right now. I wanted to ask you, I've written some notes down. It said that you went from, owning single families in Hyderabad or outside of that, and then just buying a 96 unit. So you must have gone to some conference like Best Ever or like, like the real estate guys or something to figure out. Nobody goes from single family to 96 units. So what's going on there?
Yeah.
We haven't done it. We have like 25 houses. We still haven't done it.
Okay. I'm part of a mentoring program, Brad Samrock mentoring program.
Oh, okay, Brad. Okay,
Dallas. Cool. And besides that, I attend most of the multifamily real estate conferences, whether it is Brad's or Rod Cleave's or Jake and Gino, or
dude, we were there at Rod's and Jake and Gino's, man. Gino has been on the podcast too.
Oh, okay.
Yeah.
So I was at Jake and Gino, just one in Florida, and then Joe Fairless also I attended virtually, and Grant Cardone also I attended virtually. So pretty much all the conferences I would attend, all those big ones, just to understand industry trends and get few investors from this.
Right. And is that where you find partners to have GPs and also get passive investors as well?
Passive investors, mostly I'm getting through referrals. So the people who invested with me earlier, most of them are repeat investors, and then they refer others. So that's how my network is growing. Very few are coming from outside, and my approach is I never push anybody for the investment. I send 3 emails or 4 emails for the funding. That's it. Whatever money comes in, usually that comes in those 3 emails. And occasionally I call for the deal money, but most of the time it's outside the deal. I call them and talk to them and see how they're doing and all that, nurturing with the investors.
You have
So that's
real relationships with these people.
Yeah, real relationships.
Yeah, that's us as well.
My favorite thing to do is take people out on dinners and tell them, sorry, you cannot invest with us. You don't understand anything. It's like my favorite thing, because we talk to a lot of people, and it's not about, because we don't have to buy the next deal, right? And so we always want to get like the right people with the right mindset. So when I find those people, I get really excited. I'm like, oh, okay, we could do a deal, at some point. I don't care.
So I do have an open conversation with my investors every month, all my investors, irrespective of the deal they are in. I share all the deal details, whether it is doing good or bad, it doesn't matter. I open it up and they can ask any question from any deal, even though they're not invested in that particular deal. I don't restrict them. It's like an open, honest conversation.
I like that. You should do that, Drew. We should steal all the stuff Sridhar's telling us.
No, you're more or less welcome. So that kind of helps me build a network and then raise the funds easily. So
yeah, that referral is such a key, dude. Like we haven't even tried that. That's we should do that.
Yeah, the power, I have realized it to be very, very strong and big. And some of my investors now, they have a different style of investing. They say that, hey, this year I have so much cash. You allocate among the deals. You tell me which deal, how much I put in.
Mm-hmm.
So
Nice.
that is my situation now. I have to be very cautious in telling them which one and how much. And I need to give the justification. They say, hey, why less on this deal? Why more? Because obviously every deal we bring in.
I get it. I get what you're doing. Yeah. It's funny that you mentioned that because, I was just talking to one of my best friends, Vivek. And I just tell him like, hey, you're going to be paying taxes on January 1st. It's happening. It's not something like, oh, maybe I decide maybe this year I won't pay. No. But if you put it in this deal, I'm doing a cost seg for, 100 grand, you're getting a 70 grand write-off. Your tax bracket is not cheap. It's like, do you want to pay the IRS or get a guaranteed return in like one day? Like you get 100 like return in like a day, right?
Yep.
So then people start thinking, wait a minute, I don't like the IRS,
Yep.
So it's like, it's funny.
It's funny is that's how they actually got, our generation to quit smoking. It wasn't, releasing all the health stuff. It was actually making it about like all these big fat cats with their wallets and big tobacco. That's actually what worked.
Yeah, somebody was saying that on a podcast.
Yeah, that was Andrew Huberman.
Oh, Huberman. Oh, yeah.
That's interesting.
Nice. Now, before I go or we go, I know it's getting late and you have to go to sleep. Now, I wanted to quickly touch on, when people listen to you saying, oh, I have 50,000 units, they assume you own 50,000 units free and clear, right? So can you explain how the deal structure works? Is it like a 70-30 split and then you have 3 GPs? So you guys take a third of the GP? Is that how usually it works? Or can you explain to the listeners?
Yeah, so most of these deals are like syndicated deals. Most of my regular acquisitions are 80-20, 80% to LPs and 20% to the GPs. Again, within the GP, it's not like equal share because some people do a lot of work.
Sure.
Some people do less. So we do compensate based on their involvement. For example, acquisition fees. If somebody is involved from day one on the acquisition, they have to be compensated on that one. And also if somebody is doing is simple guaranteeing the loan, so then that is a percentage. I think most of the networks does the same way too. And management, asset management, different, and the fundraise. So we have buckets for fundraise, asset management, and then acquisition and guaranteeing the loan.
Yeah.
So based on the amount of involvement, we allocate the share.
Did you move the equity to 80% because the LTV is getting lower and lower? So you're trying to keep the position of the LPs a little bit the same?
Yeah, we started with that way, like we're getting more returns for LPs, so we continued on that. Now, what I'm trying to do is reduce the number of general partners. That way, I
Oh,
will
I
make
see.
more money, even though it is the
So you
same
just have like
percentage.
you and another person, or do you have still 3 people? Or
Earlier, we even had like 7, 8 partners too.
yeah, sure.
For bigger deal, like 400 plus unit deals, usually
Yeah,
it's
yeah.
bigger raise. So now I changed my game plan. Now I'm part of a fund too. Okay, we started a $500 million fund to acquire properties.
You said $500 million fund?
Yeah.
You have a
So
$500 million fund?
yes, we are building we are sourcing the funds to that one, but our target is to reach 500 million. Okay.
That's
Um,
crazy. Yeah.
you have to put some unrealistic numbers
Yeah,
to
sure.
try to achieve it. If it is like $50 million and then within a year you reach $50 million, then again it becomes incremental 100.
We should
You
talk
won't
to
see
this
the
guy
fun.
more.
Hmm?
I said we should talk to you more so we can have like bigger goals.
Think
Yeah,
bigger.
so 500 is the goal. So by end of next year, we would start with 100 million cash into the deal, and the following year 500. Because in 2 years we need to achieve that. That's what our thought process is. We are sourcing the funds for those things so that we can pick up a lot of distressed assets. So now going forward, either the fund will acquire the asset or fund will co-partner with me as a GP. I will be one GP and the fund will be another GP.
And
we
it
will have
sounds to me like even though you're on the GP side, you probably have a whole team of VAs doing most of what you would normally do. That's a win-win-win.
Yes. So
Where are you at? Are you
has a staff. Fund has a staff. I have staff, and
Nice.
I'm also hiring on-site staff now. This has virtual assistants.
Yeah.
So that way the deals are very well scrutinized. And also I'm going to increase my stake in the deals. Right now I'm a smaller portion, but as
Right.
I started increasing the share. Eventually, my goal is all these LP investors become optional. Means if they want to join my deal, they will join. If not, I will close by myself the deal.
Legend.
So that way, they will have more protection in their investment. There's
Right.
anything
It's like, hey, I'm
goes
doing
on.
the deal either way. Like you want in or out. Like the train's already going. So
Yes. So the fund is giving me that opportunity at the moment, but eventually I should be able to do it by myself without the fund.
Nice. I love it. And just personally, selfishly speaking, we are currently interviewing our now third VA. That does not mean we have 3. That means we have let go of 2 because it just didn't work out for whatever reason. Any tips, advice, sources, websites that you use, companies?
Yeah, I used virtualstaff.ph, I believe. That is a website. And
You know about that one? Yeah. Okay.
yeah, and the thing is, I put the requirements in such a way that I look for the analytical skills. I know none of them are experienced in real estate, but I know if you get a good background, you will have a very good output. You need to train them, that's for sure.
Yeah.
So in my portfolio right now, I have 3 engineers, 2 MBAs, 2 accounting majors, and a couple of them are like social media experts, like
Nice.
like graphics, like masters in graphics type.
Right. So you have
pick the educational qualification and their skills so that they will understand your requirement easily, and they will think through and be more creative.
Yep. I love it. Yeah. So you have very highly specialized roles for each of these. Are they working 10 hours a week, 20, 30?
8 hours a week, like a regular employment.
Okay.
So I make them owner of a certain business process. So they know the deadline when they have to do. For example, every single property they create 100 plus reports.
Wow.
So even I'm trying to collect data. So eventually I will reduce the number of reports. And then now we are working on a different framework to give the complete visibility to all the investors. So going forward, all the investors will have the dynamic dashboard that they can play with.
Love it.
Are you still doing in Philippines, or is it India? Where you picking them up?
2 from India and 8 from Philippines.
Okay. So you're paying them like $8, $10, $12 an hour?
No, much cheaper than that.
Oh, really?
Like
Wow.
5 probably.
Even less.
Oh, wow.
Wow.
That's cool.
Name of the company again? Virtual work, virtual staff.
Virtualstaff.ph is what he said. I already wrote it down.
Yeah.
That's crazy, man. You can have
Yeah.
engineers for $5, $6 an hour.
It's a real thing. Yeah, I mean, in our experience, again, not to make this about us, but first guy was just a great guy, but had no skills, and so needed to be deeply trained on everything, even things that he claimed that he could do. So it just honestly became pretty apparent to me that I needed to build systems. So we let him go, and I built out the whole system. Like I have a whole Excel with hyperlinked on every step of everything that I do personally as a manager of a dozen Airbnbs and everything else that I do. And then I built that. Very proud of myself for doing that. It took a while, and then hired the second one off of Upwork, and she was fine. But then she asked for a raise, and then I said, "Hey, well, we're not, at position right now, but your work is starting to produce enough income to where that could be justified soon. So let's revisit this in a month." And that was like the last time I spoke with her. All of a sudden, it was radio silence. I'm just like, hello. So point is I just let her go, close that contract, open up a new one. And right now I'm in the process of interviewing.
So to your earlier point, right, the reason I paid less is I wanted to make sure that I get the right talent. So the ones which I like, I started increasing their salaries.
Got it. And is there a structure to that, an incentive structure, or is it just kind of like, hey, you're doing great, I'm seeing your work, here's another $1 an hour, or how are you doing that?
So every quarter, I review everybody's work and I gauge who has done above and beyond. So for them, I give a bonus, quarterly bonus. I recognize them in front of the team. And yearly, I started reviewing their salaries and start increasing for the ones which I feel that they have done some value addition to the company and type of thing. Not everybody, but eventually I will start doing for everybody, but with variation that whoever has contributed more, they will get more.
Yeah, that's great. And it's smart that you do it in front of everybody. So you're not only getting, able to praise somebody in front of everyone else, to like almost supercharges that praise, but you're also now incentivizing them to, oh, hey, Bobby got a raise. All I got to do is put in a little extra work.
Yeah, smart.
Last question I had for my selfish, endeavors is, do you offer an incentive or some kind of referral fee for those who are referring new private money to you?
Yeah. It's like whatever is allowed as per the SEC. Yes.
Sure. Okay.
Yeah.
Very cool.
All right, man.
That's all I got, man.
Cool.
Yeah. It's been an absolute pleasure.
Yeah. Thanks, man. Is there any way people can contact you, or what are you trying to do right now? Are you looking for more investors, or are you?
Yeah, the investors is a constant endeavor. So I will definitely launch more deals. Like before the year end, I'm trying to get one more deal.
Yeah.
If things were well, I think maybe one more deal. I've not first quarter, definitely. I'm planning to close 2 deals. Next year, I'm going to double the number of deals that I'm doing. Usually I do 6 deals a year. Next year, my target is to do 10 to 12 deals.
Wow. So where do people go to contact you if they want to know more about your deals?
Yeah, they can come to my website. It's simple. www.growwealth2retire.com. growwealth2retire.com.
Nice.
Oh, that's nice.
How much did you pay for that website?
Luckily, nobody took it. So
nice.
I was lucky to get it.
Yeah. We'll make sure to put that in the footnotes, man. Thank you so much for your time, Sridhar. We'll chat
most
soon.
welcome, and thanks for the opportunity. Yeah,
thank you.
I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.